right, ladies and gentlemen, it is now time for our Trader Talk segment. So this means Blue Chip Trader can actually take a breath for a little bit. We'll be talking with Brett Manning, aka Chart Trader. Good morning, Brett.
Good morning, Jim.
So, if I had some bumper music, I would have brought you in with that old Run DMC song, It's Tricky, because this has been a
It's
very
tricky.
tricky environment, to say the least. And I swear, I was watching the price action on the mini Nasdaq right around that 73.15 area, and I think there was a
hmm
chart trader hater algo going on there because they were really fighting
yeah,
you.
well, it's because it's just so crowded. It's the side that's working, and everybody knows it, and that's about the trickiest type of thing you can get. I mean, look at the SPY daily chart. I think that this is the most interesting thing. If you look at the ETF from the highs back in late April, you will see almost all white bars, almost all white candles.
hmm
I mean, that just says it all. We're down here on a series of up moves. And it's just, we're getting overnight gap downs followed by squeezes and tons of hedging and tons of short interest. And it's just, it is going down, but it has such a tough time getting there because so many people are so aggressively positioning themselves for that. And they have to get shaken out in these periodic squeezes. But it's still where the market is heading. So it's just, it's really difficult to trade in the direction that people are positioned for.
Yeah, and you can see, I don't know if you follow the same exact moving average as I do. You probably use a ton of them, but we are up against that 100 EMA in the SPY, so I'm not surprised to see people trying to buy it up here. This is a key inflection point. It was also the bottom of the opening range, so you know that when you put all these things together, there's going to be a tug of war there, and we'll see who wins out. I'm still kind of on the bearish camp, though, Brett.
Well, I mean, obviously I am until
Well,
we
yes,
get
I know. I was
what
talking
we need to get.
from the
I
bigger
mean,
picture.
eventually, I think the better direction to trade will be to the long side. It's just you have to get to where the market can do that. I think that it's not unreasonable to suggest we may be in a situation that's somewhat similar to what we saw in the fall of 2015. So we had a big crash in August of 2015, and that was precipitated really by a sense that well, a lot of it was that the commodity side of the market was starting to fall apart. Crude oil was starting to fall apart. And we were starting to get some rumblings of, a lot of supply chain issues for different companies. And the whole sort of industrial side of the market was heading probably for a big earnings hit. And everybody was short. It was a situation where we had one of the craziest sentiment bearish extremes out of that August low that I've really ever seen. But down was still right if you look out the next 6 months. We just had 3 months of upward chop that we had to get through after that to kind of reset things. And when we got into December, we had a market where bullishness was back even though the market was still below its previous high. And then we rolled over and we really got thumped. And I think that we could see something kind of similar to that. The awareness that we are in a situation where this trade negotiation has completely fallen apart and will probably not be resolved anytime soon. And that awareness is what people are adjusting to right now. It will still be true in a few months, but we may need to go through the process of rekindling some kind of bullish positioning and fervor before we roll back over a bit. So I think we could have that kind of middle outcome here where people reduce their hedges, shorts get squeezed back out, and we reset sentiment. I think we've really, further than the sentiment indications are easy to see, I think we've really gotten to a spot of a tremendous amount of pessimism.
All right. So where do you want to jump to? Because there's so many markets that are interesting today. The euro, gold.
Euro.
Yeah, all right. So let's go to the euro, and let me get a chart available. I had one, but let's see. So let me just fix the one I got so it's a little cleaner. Why don't you go ahead and prep it, and I'll show it on the chart in just a moment.
Well, I mean, this was another sign of that sort of potential for a cascading kind of waterfall decline out of the grinding downward channel that we've been seeing in this market for about a year. And, really seemed like it had gotten past a point of no return, and then it turned around just off our open and just started to launch back higher. So it's another situation, just like equities. Everybody knows that the eurozone is the downside leader, in any sort of cyclical contraction thesis, and everybody's positioned for that. And because it's actually going in the direction everybody's positioned for, we're getting a downward move in a series of squeezes. It's the same kind of dynamic. It's just, I mean, I can't imagine for people who are really just focused on that market and they've got an economic thesis on Europe, this must just be kind of a torturous move down, because they just keep getting slapped in the face. Every time you get a lower low and you think it's finally going to let go and you're going to see 2 or 3 days of sprint to the downside, it forms a low and squeezes back up and shakes everybody out who wanted to add into the decline. It's got to be such a lure to see that level break and to have a bearish thesis on the euro and to have some short positioning. And you see it going, you're like, finally, here's the big payoff. I'm just going to triple up right now, and then you get slapped in the face with this type of rally. It's really tricky. I mean, it's a similar dynamic, though.
So, would you still lean to the bearish side or not on the euro?
I have been generally speaking looking for a squeeze. We talked the last time. I said I would like to short into a big squeeze, like a much bigger squeeze than this. Something where you get 3 or 4 days of just. We saw one back in March. That was a kind of good version where you've got a lot of short interest. You get a big squeeze up. Really kind of crushes people out of the situation, and then you turn around and roll back over. And I think that's how you're going to have to play that market. And I would like to play equities the same way, but we're not really getting that level of squeeze to the field. Even the rallies we've had have seemed a little more constructive, and then we get hit with more bad headlines. So yeah, I mean, I would like to be short the euro, but not on a breakdown, because that's turned out to be so treacherous, and because we know there's 100,000 something net short contracts being held right now in the futures, and I think that's a reasonable proxy for sentiment.
All right, so back in the March timeframe, we talked about a trade. You laid it out, and I'm going to refer to the Trader Audio chart. Here's the Euro futures, and I'm looking at the early March timeframe where we got this big candlestick down. So pretend like you don't know the future, everybody. I'm going to move the chart over so you can't see it. So let's say we were talking on this day, which ended up being March 7th, all right? So we have this big down day, which looks somewhat similar to what we had today. And then Chart and I were on the air, and we talked about a particular level. That level was 115, if you remember, Brett. And you didn't end up taking that trade, and I know you were kicking yourself about it.
Yeah.
Now, so let's pretend we get a similar setup. We're going to fast forward again on the chart to today, and let's pretend that we do get a little grind higher and then maybe a squeeze that comes into play. Where's the next level of interest?
Well, let's see. There's a couple of different ways to look at this. If I just kind of zoom out and just go with my gut feeling, I would say 113.80.
113.80. So guess what I'm going to do? I'm gonna put in the Florida Gator Blue chart, or Florida Gator Blue line. There you go. It's right there. And so I'm going to have that, and it's going to mark it. And so I will be able to highlight to you, hey, Brett, we're getting close to that level. Remember we were talking about that on Trader Audio on May 23rd, and then we can hit this back up, and we'll see how things are brewing over in the Eurozone then. But if you do just take, for example, how long it took for that to happen on that March 7 big move to the downside. So we had, let's see, 2.5 weeks or so. Looks like about 10 to 12 trading sessions, I would say, before that actually occurred. So you've got some time before this actually might happen, right?
Sure.
So I was just laying that out for people. I like to get trades out in front of everyone before they happen so everyone can be prepared for it. All right, now that's a good way to get back into gold.
Let me express a caveat to that whole idea real quick. Let me interject.
Sure.
There's something that we talked about before that I call eating the tail, which can be a particularly important technical signal. It's not impossible that today's rally in the euro, we could come in tomorrow and it's most of the way gone.
Yep.
So if we leave that tail there and then we gradually move back down through it without rallying above today's highs after that, that's a particularly bearish pattern. Because you bring in, for the first time in a while, we might right now start to have a bunch of very short-term minded, very weak hands coming in alongside euro because of this technical action, because of this hold of that level and the reversal back to the upside. That would be particularly bearish to see this eat the tail tomorrow.
All right, so let's get back to equities real quick because mini Nasdaq is breaking down, and I had hoped that we'd be talking about being able to take your third exit, but well, beggars can't
Second.
be choosers. We're about on your second, so we're hitting that zone that you had highlighted, and that zone is
72.75 to 72.85. That'd be
okay.
the overshoot of the low that I highlighted this morning before the open.
Okay, and would this be a good example of kind of that tail, that eating the tail move that you were talking about?
Which tail?
In in the let me
What
see,
time frame?
30 minute time frame, or no?
So I think I kind of get what you're saying.
This one right here at 9 o'clock, 9 o'clock Chicago time. You see that
Right.
candle?
Yeah. So the pattern when I say that, I mean that is the same dynamic, I guess. But the pattern when I say this, usually on whatever chart I'm looking at, it's the very next bar. Like you
Oh,
put in what looks like a doji, and the very next bar eats through it. And
okay.
it's just kind of, that's. I mean, yes, obviously it formed a low. It's the pattern that I shorted. The pattern that I shorted basically we put in essentially a lateral consolidation formed by a couple different points of trying to hold that level. And when the bounce doesn't follow through, you come back down and you retest it. After you have kind of put this in as the key thing, when you're in a very oversold market, when you're in a market that's getting ripped up, where there's a lot of pessimism, and you get that sense of the new hope that we've defended a level and you're starting to see a bounce, the market's down enough that you're going to have a lot of weak hands come in and just say, I'm going to throw some money at this because if that's a key low, this is going to be the spot to be long. And when you start to, when you form that lateral sense of the consolidation, it's not really, we didn't really get a lot of vertical action on that bounce. We got a couple different tries to pop higher, and we kind of grind sideways for half an hour or 45 minutes and then roll back over again. And that's when all the people who come in and they've looked at this as an oversold bounce candidate because they watched that level get defended, that money's all really vulnerable. It allows you to get this next level breakdown. The force of those bars when we went through, when I posted to say we're about to see that breakdown, when I said something about, the question will be about follow through,
Hmm.
the run of orders I was talking about is those weak hands that have come in that are looking for that. They're really vulnerable. They're really easy to beat out. You just push through them, they're going to stop out. And it's just it's the reason why that setup generally works well. You get the oversold market, you get the bounce that turns into a lateral consolidation, and you roll back down, you start hitting those levels again. There's just a pocket of orders you're going to be able to hit, and we're going to be sellers. So it's just that's the main reason to take that setup. You don't know how much follow-through you're going to get, but you can be pretty confident that you're going to get something out of it. You're going to get maybe a scalp, maybe a secondary bank, and you're going to get your stops up so that, you really have not much chance of taking any kind of serious loss. You have a good chance of getting something, and who knows, we might get a lot of follow-through to the downside. We might see that we get a pretty vicious extension here down to, 72.50, 72.40, and, that's out there as a possibility. But the reason to take the setup and trust the setup is you're most likely going to put yourself into an advantageous position where you're given something, you get your risk up, and then you have what we talked about before, sort of a free look. So I almost got chopped out of that right off the bat, and that, again, I just chalk up to being at the level and having so many people leaning on this market. But those vulnerable orders were still down there, and it just took a little bit longer. One more cycle through of shaking people out, and then we started to hit them.
All right. Just on the flip side, just out of curiosity, I'm gonna still focus on the 30-minute Nasdaq futures chart, and
Okay.
the most recent candle, the one that broke down. You've got a pretty bearish candle right there. Let's say, for instance, this next one that we're forming right now does the opposite and pushes through. Would that be a eat the tail setup to the long side, or no?
Well, I mean, I don't. No,
No.
no.
Okay.
I mean,
Because
with each
there's not a
detail, you
tail.
want to
There's
see
not a wick, right?
a doji that looks like a reversal,
Okay. Got it. Got it.
right? Something that looks like it's affirming a level with a big doji tail, and then immediately right after that bar closes, the next one just starts to eat through it,
Okay.
and it's just suck them in and spit them out. As far as people who are betting on the reversal, you suck them in and then you kick them back out right away, and that's just. I mean, it's when you see that tail starting to go, it's the same the same as the dynamic that I just explained. It puts you into an immediately advantageous position because you know off of a doji like that, particularly if it's on a time frame like a daily bar or a 60-minute bar, you know you're going to have weak hands there to kick out.
Mm-hmm.
Like that doji pulls in a certain type of money, a certain type of technically oriented, weak-handed money that's going to probably be playing with stops. And if you're already in a situation where you've got a reversion to the mean possibility set up, people feel like it's gone too far one direction, and then you put in that tail, you know you're going to have that money there. And if it immediately starts to eat through it, it just shows that the offer is still dominant. The offer wasn't chasing to the downside. And that's really the dynamic. So the tail is there not because sellers are exhausted. It's because sellers are still sitting on the offer. They're still sitting above the market. They don't want to exacerbate declines because they're owning it and they want to get off supply without depressing the market. So it's a tactical sell, and you've got tactical order flow sitting up there, but and that's so dominant, that's so big that there's no chance that reversal can happen yet. But the tail gets put in, the doji gets put in, so the weak hands are buying into that big offer, which is just that lead blanket idea, which I kind of talk about. It's sitting there. It's the reason the downtrend is happening. It's not a panic. It's just a tactical distribution. And you see the tail where you get these little moments of panic, but then people buy back into it, and then you've got weak-handed money slapping into that dominant offer. And when it starts to roll over again, you know where the strong hands are, they're selling. You know where the weak hands are, they're buying. So you get that extension. It's kind of you can operationalize this sort of game theoretic way of looking at this type of pattern. There are a number of patterns that use that same kind of dynamic. And I tend to look for those quite a bit when I see that there's a dominant side to the market, but it's tactically dominant. And when I see the other side, I get the sense that it's easy to imagine that there are a bunch of people who are looking for a reversion to the mean. And when you see a reversal signal, but it doesn't really challenge the thesis that there's still that dominant side of the market because it's tactical, it's sitting back, then you've got an easy opportunity for trend extension. So
Not only
there's
that,
a lot of different things that I use that basic philosophy for.
not only that, I think sticking to the game theory a portion of that, when retail traders see a doji, that's a very popular pattern, and if they see a bullish doji, which is what you probably want to see on that, right? You'll have the follow-through from the retail traders that are trying to get in, taking advantage. Oh, I've just got my reversal signal, and boom, that's when they get smacked.
Right, exactly.
Okay.
So I just took another piece.
All right. A real live trade from Chart Trader. Look at that.
Well, we got the second level I was looking for right about in the middle of it. So
I know. I was trying to filibust a little bit so we could make sure that we got that in there. So you're on record now. An official trade from Chart. All right. So moving right along. Let's talk about the gold here. You are sitting pretty now. Well, prettier anyway in the GLD. Yep. I'm going to look at the gold futures chart because I know you tend to reference this quite a bit, and I did take the liberty and drew some trend lines on this daily chart that two of them anyway. They connect the dots to an old trend line that we just got through the undercut zone. We had gotten through it before, and then I drew another trend line at the top, so if you can see what I'm talking about on the Trader Audio, Brett, you can see what I'm saying. Now we've entered into that trend line zone where I suspect 1295 might be another key area that you'd be looking at. Is that a target for you, or are you looking for something even bigger?
1295, is that a target?
Yeah, maybe
I mean, my target is 1400.
Oh,
basically.
Well, yeah. Well,
kind of 1400 or
what
bust.
Am I talking about?
Yeah. So I mean, this is the idea that I'm playing a weekly chart pattern, and silver's a little troubling right now because of the way it's behaving, but kind of has just a trending feel to it. But today's a good sign, and it's good to see the euro. When the euro was down a lot, when the dollar was up a lot, the gold was still surging back. So that's important. The fact that it is back above that 1275 to 1280 zone is important. I do not, at this point, want to see it go back below 1275. I think that would, even though I'd probably stick with the strategy because it's small, it's unleveraged, and it's a longer-term position, and I've got a ton of room to my stop. But I would probably feel like if I see it move back under 1275 at this point without moving back above 1300 in a straight line, I would probably start to feel like we're going to need to make a lower low in this pattern. We might see that 1250 area. I don't know that that's going to happen, but it would start to make sense if we have this bounce. This bounce forms kind of almost a short setup feel to the pattern if we start to move back lower. But I'm in this for different reasons, and I believe that if you look at the weekly chart, it still looks like a gigantic bullish descending triangle. And we still have every reason to believe that the whole larger thesis of, there's going to be big family offices that need to start to gain some exposure to gold in the face of what looks like kind of a little bit of a trap for policymakers if we start to see a little bit of a cycle rollover. So that's the big idea, and the long-term technical pattern supports that, and I've got plenty of room, so I'm really not trying to look too closely at it.
All right, well, then we won't look that closely at it, and I'm going to move it right to the side. But one thing I do want to look closely at is crude oil. You put in a note on the in-play page about the key level. We were already down over $3, $3.50 or so, and you went out and put in a level like 58.10 to 57.90 or so. And again,
yeah, basically,
I used the Florida Gator colors, so I remember what it was, and we bounced right off there. However, now we're consolidating. Do you think this might
sideways?
Yeah. To me, I think this sets up for a little bit of vulnerability to the downside. What do you say?
It's similar to what I just shorted in the Nasdaq. You've got a market in terms of the game theory of the different participants involved. You're putting in a lateral consolidation there, and you're off of this kind of oversold. You can imagine there being a reversion to the mean bid. You put in a couple of attempts to hold this zone that was, I think, reasonably foreseeable as a zone. It comes off of a prior consolidation that you can see where it needed to explore this particular area, and then you'd probably see some demand come in. But if we just trace sideways and then we gradually start to roll back over, I don't think there's any question you're going to break that low.
Yeah, I think so too. But they're definitely fighting it. But I'm going to keep that as a key level here, key inflection zone, if you will. And I like to keep these type of things on my chart for a while because once, let's say we do break down, then when they come back up, they end up being resistance. And I know I hammer that theme over and over and over again, but the more that I do, the more it becomes a habit for not only me, but the listeners out there. So definitely, I'll try to remind everyone what this level was when the time comes, but keep an eye on this level right here. I usually have this chart up all the time, at least when I'm here. So let's say we do break down, Brett. At what point do you start getting interested on the long side in crude where we might get an overshoot?
Say that one more time, sorry.
So we break down through this, we'll just call it the $58 level, all right?
Okay.
Where does the overshoot come in on crude where you'd start thinking, okay, from a positioning standpoint, I know that some of the previous talks that we've had, and maybe this is a precursor to what you're going to talk about with Gavin later on today, but there's, if I recall, there's an under-hedged, you speak to it a lot better than I do, but from a positioning standpoint, there's got to be a point where it becomes very attractive once again, right?
Yeah, why? Absolutely. I mean, especially with this level of cleansing. And I think a lot of what this is, I'm not really sure where the Middle East situation is, but I think that people started to get the feeling that we were, on the verge of a military conflict there, and it seems like that's gotten way off the front page at this point.
Mm-hmm.
And I think that some of what we were seeing to hold prior levels into the last correction was a lot of commercial hedging there, and maybe those positions are going off the table, and that might be why we're seeing such a dramatic downside. But yeah, I mean, from a positioning standpoint, this market could go lower for sure. I think it takes probably, I mean, you could see under 55 before you're at the point where I think that you've seen a big exodus of speculative long-side money. So I think that if it's trending this hard, if we see lateral consolidations after a drop of 5% without the ability to uptick, then it probably has further to go. It needs to get on its horse if this is a zone. If people who are buying into that low are going to be right today, this thing needs to start showing you a sign pretty quick here. Otherwise, it's just a pause in a river. And I would think that we may see some bounces, we may see some consolidations, but you still got almost 500,000 net long contracts on the large spec side of that market. So there's a repositioning dynamic that's going on here, and some of that's probably bouncing back out. So I would think, we hit that last consolidation level. You've got some other levels maybe in place in here. Let me just take a look real quick. The levels, generally speaking, I would say you're going to have something at 57.35 probably on an overshoot
Wow,
of that.
look at that. I had that. And
Oh, did
I
you?
just, well, you know what I did was I just took the Fibonacci from the December 24th low to the high that we put in, drew a Fibonacci replacement, or a Fibonacci retracement,
Retracement.
and it came in at 57.32. So that's where I was
Okay.
kind of looking. I think the 54.5 zone, if you really want to
Yeah,
get,
I was just about to say that next.
yeah, if you, yeah. So, all right. Hey, look at that. This is getting scary, Brett. I'm starting to think like
That
you, or
is.
you're starting to think like me. I
Well,
don't
you
know
know
which is
what? You're
worse.
looking at what's interesting is you're looking at the fib levels, and I'm looking at just pattern structure. I'm not. I was referencing in no way fib levels. I was just saying, okay, where's the line? Where are people going to be interested? Where's the overshoot? And that got me to 57.35 and 54.50.
All right. Well,
So that
yeah. Well, the
and
good
they match
news,
up with the Fibonacci, which is interesting.
yeah, that is interesting. And the good news for you is that you're not thinking like me, so you're safe. So there you go. All right, Brett. So we really did cover a lot, and I know you're going to be on with Gavin a little bit later this afternoon. So is there any other markets that we should cover that you really want to highlight, or any other points you really want to stress to, that we can take home?
Yeah, take a look at TLT.
All right, one second. Let me get this out of the way. All right, got the TLT chart on
I think
the.
this is an easy, accessible way for people to say, here, think about the bond market.
Okay,
This
daily
is,
chart,
I
weekly.
mean, it almost doesn't matter. It's all looking the same.
Okay.
Monster breakout.
Mm-hmm.
You got a huge breakdown in interest rates. And if you look at Fed funds futures, you're seeing some interesting things right now. And I think that this is maybe ultimately why the euro turned around, because you've now got a situation where Fed fund futures are showing in January of next year, the almost certainty of having had at least one rate cut, the likelihood of having two, and the possibility of three or even four. So the underneath the surface betting game on where interest rates are heading is starting to really, I mean, the focus right now is on, how many rate cuts are we going to see in the next few months, not whether or not the Fed is going to stay on pause. And there's no odds of a rate hike looking out as far as you can go. Nothing. Not 1/10 of 1% chance of a rate hike. And big speculation that we're going to see a series of rate cuts. So that's another sentiment indication. And I think you're starting to see that in long end interest rates. And this inversion of the yield curve that I mentioned earlier today, the 3-month to 10-year, this could be a little stickier. And we haven't seen any of them stick. We've seen little minor blips there. Now, maybe this is marking the sentiment extreme. Maybe what we should do for sentiment data is look at the 3-month to 10-year, and anytime it inverts, that's when you buy the market. I don't know. That's been a pattern.
Yes.
And it's not impossible, but and this is all about cycle. This is all about whether or not we're starting to see something. Maybe the trade war, maybe the issues with China are a catalyst that is allowing for a natural vulnerability to begin to manifest itself more prominently. We're going to see lots of guide downs in earnings and all sorts of stuff, and then we're going to go into a kind of negative risk aversion kind of vicious cycle, and see some development there as far as the economic cycle. And we did build up some prepotency for that. We talked about that toward the end of last year. But, it may be that people are just at a trough right now in terms of what their beliefs are about the long-term cycle, and that this is precisely that buying opportunity. And I guess I lean a little bit in that direction simply because we've seen such a quick move in terms of sentiment and hedging to see this kind of, this level of rapid kind of turnaround and the willingness to kind of throw your hands up and give up on the idea of that next level extension. And I feel like that's a hole. That's a positioning hole that needs to be filled in, and the only way to fill that in would be buying. And ultimately, I suppose it just seems like this Fed has been, central banks around the world have all been just super proactive about wanting to be supportive. And so seeing that we're going to see rate cuts doesn't necessarily mean we're going to see recession, given that mentality. So, but I think, it just, the money moving into the bond market is crazy right now. It's just flying in.
I had a question come in on the feedback that I don't know if you saw or not, but it says you mentioned the 3-month to 10-year yield inversion. At what point does 2.3% start to compete with the yield on the S&P? I don't know if you saw that or if you can even answer that or something you've looked at, but if not, then perhaps you can address it a little bit more on your flow show.
Yeah, I definitely will. But I mean, right now it looks like the average dividend yield for the S&P is 2.2%. So, yeah, I mean, that's been one dynamic. We talked about this a lot last March, I think, was really to focus on the idea that we had started to see interest rates move solidly above the dividend yield on the S&P. And, you know, that was when you start to get that interest rate move, that starts to become a big problem for stocks. And I think that it was responsible for a lot of the volatility that we saw last year. You have what I call the refugees from the bond market, people who were unnatural participants in the equities market for close to a decade because, you know, they didn't want to basically guarantee themselves a loss in things like pension funds. When interest rates are at 0% everywhere, they were moving into, I think, a diversified portfolio of like blue chip stocks playing as a dividend yield to fill that same hole in their portfolio management. And when you start to get the interest rates moving well above the S&P dividend yield, you start to get that money moving out of the stock market. And I think that is some of the floor that we saw drop out last year in November and December, the vulnerable money to really kind of give you that powerful extension to the downside. There was a safety net that had been there for the market in most corrections that we'd seen over the last few years that was suddenly gone. And now interest rates are moving rapidly back lower, and pretty soon you are going to possibly at least remove people from leaving. The refugees from the bond market who are still in the stock market are unlikely maybe to move right now unless that's what's happening. But I think you need to get much lower than this to force the same kind of dynamic, to force that money back into the stock market. I think you're talking about a risk based decision, like the calculation to say whether or not that 2.2% in the S&P is favorable to, let's say, bonds dropped at 1.9%. You're also taking on risk by moving into equity positions of, you know, a bear market, and that's going to impact your essentially what's kind of like a cost of carry in that from that standpoint. So I think that we would have to see a massive dive in interest rates from here for that to start to become a dynamic that's important to how equities play.
All right, and then just one last question, and that's back on the Nasdaq. Is your stop in this one still at the what was it,
73.20.
73.20? So keeping your stop as is. All right, and
Yeah. I mean, I may give up on the position ahead of that if it looks like we're seeing constructive action. So it would just be a judgment call. But my stop is there, so I can't get hurt on this relative to pre-entry.
all right, and your next target might be?
That's going to be based on mode. My next target will be the next side of this trade would be if we start to go into a little bit of a panic field tape, and then it's just about watching for when I feel like we've really kind of triggered that level, and maybe we start to see put call jump way up, which, you know, we haven't really been seeing. Put calls just over 1. That's nothing.
Yep.
I mean, if we see, you know, 135, 145, 150. You know, that I kind of want to think of the target in those terms. Otherwise, if we just grind to the downside, you know, I mean, we've already hit the technical target I had this morning, so the question would be, you know, whether I want to proactively cover the rest, but I'm inclined to just let this kind of play out now. We've already banked something on it. We've already got something decent out of it, and I want to see what it can do.
All right, well, guess what? We actually did talk about your third target on this show, so good stuff.
All right.
All right, Brett. Well, hey, we're going to hear from you again later on this afternoon when you and Gavin do your flow show. So I'm going to be looking forward to that, and we'll get you jumping on back here in the afternoon.